Hello and welcome. I'm your host, Alex, with a brand new episode of Economic Insights. Also with us here, Selim, a market veteran of many years and the producer of our show. Welcome.
Hello, Alex. Great being here.
It was a relatively calmer week this week in the financial markets, with risk assets recovering and yields lower, even though we had quite a few events to watch out for. Describe to us what happened.
Yes, that's true, Alex. Stock markets recovered slightly. We've seen relatively smaller moves in the bond markets as well. That wasn't true everywhere, but we will get to that shortly. But I think more than what didn't happen was more important. The sound bites from the White House were relatively muted. On the economic front, there were few announcements that would rock the boat. So I think despite all the look beyond the short term rhetoric, the administration is still closely watching the stock markets.
Okay, shall we start with what happened then? The big event was the Fed meeting.
And it went relatively smoothly. On the surface, the Fed sounded more dovish. Jerome Powell's press conference definitely was tilting this way. As expected, the Fed members updated their economic growth lower, inflation higher, and the unemployment rate upwards. Powell attributed all of that to the uncertainty in the economic environment and called potential impacts of tariffs transitory.
Oh, we are back with that word?
I hope not. It didn't go well the first time. Still, when we look at the composition of the dot plots, the path Fed officials expect the rates to follow showed a bias to keep rates higher for longer. 50 basis points are still penciled in, but the number of Fed officials that see two cuts actually decreased. Powell himself reiterated they are in no hurry to cut rates. When you look at the details of the data that came this week, even though retail sales was better than expected, there are hints that point to an erosion of confidence in the consumer's behavior. Restaurant sales were weak, despite the February weather being warmer than average. Auto parts sales were also on the weaker side. Import prices, a data point that rarely gets much attention, was higher than expected, reflecting the impact of tariffs and possibly more importantly, the tendency of companies to pass on the hikes to the buyers.
Wow, that's very interesting. So is it fair to say that Fed is trying to buy time until they know more?
Definitely. And they are not the only ones doing so. This was a common theme emerging this week in the majority of the central bank meetings we had. Sometimes the best thing to do is not to do anything, something all good market players know very well.
Yes, we had quite a few central bank meetings this week. Shall we start with the UK MPC?
Do you mean the biggest emerging market in the world?
Yes, I think the Heathrow closure on Friday cemented that.
Bank of England decision was a bit of surprise to the market players. They tilted decidedly hawkish. The vote split was 8-1 with one member voting for a 25 basis points cut. This compared to 7-2 previously where two members wanted a 50 basis points of cuts. Additional wording in the minutes note that monetary policy is not on a preset path also point to this hawkish shift. As a result, we saw front-end yields selling off more than longer end, twisting the yield curve flatter.
What about the Bank of Japan and the Swiss National Bank? They also had their meetings this week?
Yes, BOJ was mostly a non-event. They tried to play a very balanced tone while pointing to possible risk factors, such as the economic impacts of tariffs and the currency, as well as the ongoing wage negotiations. Most analysts still expect a hike in June. Swiss National Bank cut rates by 25 basis points. This may be the last cut in this cycle. The recent depreciation of the CHF, resilient domestic demand in Switzerland, and growth positive policy announcements from Europe likely will alleviate risk of deflation for SMB.
Looks like they're all trying to buy time.
Very true, Alex.
I want to talk a little about the FX markets. Germany passed its spending bill, but we saw the euro lower.
Yes, Alex, that's true. As we mentioned last week, the effects of the spending bill was mostly priced in. Now the attention seems to be shifting towards tariffs again. In the short term, the path of least resistance is lower until the big day, April 2nd. US dollar might be getting a boost until then. There is a great deal of uncertainty regarding the tariffs and retaliatory tariffs, which will keep the markets on edge for the next few weeks. Canadian dollar, Mexican peso, CNY, and euro all seem to be at risk of increased volatility. Given this coincides with the quarter end period, we may see a larger than normal demand for US dollars and safe haven demand.
How is this affecting the emerging markets in general?
While the EM space has been mostly resilient in the face of tariffs uncertainty, there are cracks forming up, mostly due to local politics. Colombia was one of them this week, where the finance minister quit and the peso tumbled. Indonesia was another. The central bank had to intervene forcefully as the government's spending policies created mounting concern. The central bank had unexpectedly cut rates earlier this year in the face of slowing economy, and then, of course, there was Turkey.
Yes. What's going on there?
President Erdogan's main political rival, following his university diploma being annulled due to alleged fraud, was taken into custody on Wednesday. The charges against him constitute pretty heavy accusations such as defrauding the municipality he runs and terrorism. The market's reaction was very harsh. At one point on Wednesday, Turkish lira had depreciated 11%, a multi-VAR event. Over a 3-day period, the state banks acting on behalf of the central bank sold close to $25 billion, according to market sources. The stock market lost nearly 20% from its recent peak in a matter of a few days.
Wow, how did the central bank react?
CBRT had to hike the lending rate to 46% in an unscheduled meeting. They cancelled the weekly repo auctions indefinitely, as well as announcing liquidity bills to drain liras from the system. These will squeeze the funding rate significantly. The reaction is a positive signal that the central bank wants to keep the focus on inflation.
How is the situation evolving? What should we look out for?
It's very fluid, and it's hard to say if it'll get much worse or will die down. There are protests taking place in large cities. The market players did not want to take the risk of what may happen over the weekend and were sellers of Turkish assets heavily on Friday. Depending on how things evolve, a relevant calm may return on Monday.
Famous last words? Ha 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 ha.
I hope not.
What about South Africa? We had the CPI and the MPC meeting this week.
Yes, Alex. The inflation came in lower than expected at 3.2% annually. The core was at 3.4%. There is a possibility that the inflation can undershoot the central bank's forecasts for this year. In fact, the 4-2 voting split in the MPC also reflects this to an extent. Downside risks to growth were highlighted, and the SARB is trying hard not to close the door to rate cuts. The markets are pricing a rate cut of just under 30 basis points until year-end, but the threat of tariffs and a possibility that the country may be removed from its free trade agreement with the US are factors that can create an environment where more may be needed.
Trying to buy time. Excellent. Very informative. And tell us more about what's on the agenda for next week.
Obviously, we are closely watching the events in Turkey. Things are changing fast even as we prepare our podcast. And while it is still another week away, April's second tariffs deadline is approaching fast.
We will evaluate those one day at a time, or maybe hourly.
There is quite a lot to digest in terms of economic data as well. The week starts off with PMI sentiment indicators. And even though the US PCE will be the focus on Friday, French and Spain inflation figures will also attract attention. Let's not forget UK CPI on Wednesday either. German IFO and US consumer sentiment surveys will also be closely watched. Let's not forget, there will be a lot of Fed speakers on the wires this week.
Another nail-biting week is on the cards. Thanks very much, Selim. This was very insightful.
Thank you, Alex. Great conversation.
Well, folks, this is all the time we have for this week. Thanks for tuning in to Economic Insights. Please don't forget to subscribe and comment. And don't forget, this is not investment advice. For that, please consult a professional. Until next time, good luck out there.